Glad everybody could join us. Just in case you didn't know, there have been a few really pretty major changes to the SEC regulations, really that affect kind of the exempt offerings. Really just kind of want to talk through those, make sure that everybody kind of understands what's going on with it. And most importantly, kind of get a little creative with how does this really apply to you? How can you make use of it? To tell you a little bit more about my background, by training, I was a stockbroker, very used to dealing with the investors and the entire sales process. My passion is really entrepreneurship. Love starting businesses, running it. So really, I handle a lot of the front end consultations and discussions and strategy. Honestly, it's the funnest thing in the world for me. So I enjoy every minute of it. And my widget is, of course, being an attorney. I am kind of assuming that everybody that is listening right now is basically the same. You've got some great training. You have a desire and a passion to live life to its fullest. And we all just kind of have our individual widgets. So really a big part of going through all of this today is how do we apply the new rules, new lessons to our respective widgets? And pretty important thing to say because, going along with this disclaimer, I'm going to be making suggestions, coming up with thoughts and hopefully your mind starts going at the same time as well. Not legal advice, purely educational. Thank you for your time. And let's just start carrying on. So to touch on really where the big changes started to happen, we're going to focus on Regulation A, Regulation CF, and Regulation D. I'm going to briefly talk about each one of those, but that's not the point of us being here today, so I'm not going to get too deep into it. But there have been a whole lot of crowdfunding updates. That is Regulation CF. All of a sudden, it became usable. There's been changes in integration rules. We'll talk more about what that actually means, but basically integration means we'll talk about it. Finally, there's actually been some general solicitation changes that in fact affect Reg D Rule 506B offerings. There is now a way that you can actually do some performances, but there's a lot of limitations on how that is supposed to work. You can also do some testing the waters. There's been restrictions on that in the past. You can do a lot more of that now. And finally, there have been over the past few years, they call it the bad boy disqualifications. And frankly, there was like different rules to get disqualified from doing a Reg D versus a Reg A offering versus the crowdfunding. And they just updated it across the board. So every offering and offering exemption applies with the exact same bad boy disqualifications. And that is, hopefully you don't have to worry about it, but it's things such as if you have felonies or misdemeanors, there are certain misdemeanors that you can't actually sell securities or work on that if you have those issues. But just to touch on the different offerings, and I'm going to say this now, if you want a lot more details for your own education and research process, go ahead and just email us at admin@crowdfundinglawyers.net. Helpful chart. We're going to send you a much more in-depth chart. It is also available at our website, crowdfundinglawyers.net. Big thing is, I'm just going to say this straight out. It ain't updated yet, so don't download it today. But in any case, we are going to primarily talk today about regulation crowdfunding. That is regulation CF, Reg A, and Reg D. Quite a few of the rules changed, but just to kind of touch on, there's still the 506B, which in fact had a pretty major change to how to work with unaccredited investors. So with that, the Reg D Rule 506B of at least what's listed here, that's the only one that you can't have general solicitation. General solicitation meaning basically advertising. If you're putting your information and your investments into Facebook or LinkedIn or just out into the internet public, that can be construed as a general solicitation. Oftentimes seminars are, there are certain circumstances that they're not. We'll talk a little bit more about that. But all except for the 506C offering do allow for some limited number of unaccredited investors. The regulation CF and A, actually, there are documents that get filed with the SEC, and there's also limits on how much you can actually raise. Just as I'm running through this real quick, it is very important for some of the exemptions or all of the exemptions to know what an accredited investor is. And kind of as this presents, unaccredited, you're not sophisticated, not rich. There are some still investments that can be made. Sophisticated, you're smart, but not necessarily accredited. And accredited investors, there's actually a number of different categories to consider and to go through. However, the ones that most people actually use are if you make $200,000 a year, if you are single, $300,000 a year with your spouse or spousal equivalent, or have more than $1 million net worth. For all of these characteristics, and there's a list of about 10 probably additional categories, these investors are accredited. And for each one of the different exemptions that we go through and talk about, generally the unaccredited versus accredited investor, it's an important thing to know. Now, this has actually been the biggest change is the regulation CF, crowdfunding. We're the crowdfunding lawyers really looking forward to helping you with these types of offerings and getting you through the process. And it's just simply different than what people have really been used to in the past. But you can work with accredited, unaccredited investors. There are requirements of where a regulation CF offering needs to be placed, generally through a FINRA registered crowdfunding portal. But you can do this really for all types of businesses and real estate projects. Now, as I was saying, it is now up to $5 million, but there are still limits on how much unaccredited investors can invest. And this is actually part of what the changes are to increase the amount of investment that is allowed. Previously, if you were unaccredited, you could only invest the lesser of 5% of your annual income or net worth. Now it's 10%, or now it's greater. The greater of your annual income or net worth. And that's not just for unaccredited investors, that's an income or net worth of less than $107,000. Now, if you have an investor that has a income or net worth greater than 107,000, but are still not accredited, they can still invest 10% of the greater of that net worth or annual income. And now, previously, the accredited investors had some limitations. It is currently unlimited. So, to talk through really what the changes are, The limit used to be a little more than $1 million. And as we all know, with a little more than $1 million, it is difficult to get too many businesses off the ground, really to apply it to real estate projects. It was very unusable. Now at a $5 million cap, there's a lot more that we can do with it. It's as easy, and procedurally, we treat it the exact same as we go through the process as a Reg D offering. Same types of considerations as your business and opportunity is coming together, the things to consider. Just now, all of a sudden, instead of $1 million worthless, it gets to be $5 million. And I know for a large extent of the people listening, it'll cover a lot of your deals. That $5 million limit, that is on an annual basis. So you're not able to just do offering after offering after offering. And now's the fun part to start getting a little creative. If you are doing a franchise model, and let's say there's $500,000 franchise, well, one general, the master franchisee could actually do one offering and open up 10 locations. There's also the opportunities to, if you have a real estate play, and if it is a smaller raw land development, townhouses or whatnot, you can either add the properties together to have a larger offering, or alternatively, you still have the opportunity to do multiple smaller offerings. Regardless, you can do them. You always have to pay attention to the integration rules that we will talk about later. But integration isn't a horrible thing. It's just something to be aware of and make sure that you don't have any issues with. But with the regulation CF, it is the $5 million per year limit that anyone can go through. And then just to briefly talk through with regulation CF, that's the crowdfunding. What the process is first you have to kind of develop and strategize your plan. What are you raising money for? Are you allowed to raise money through Reg CF with this? Also, as I was mentioning, you have to decide on which crowdfunding portal you want to work with. And you also even have the opportunity to set up your own crowdfunding portal. Now, there's quite a few of them, a couple hundred at this point, and you can look them up on the FINRA website and easily search for what's available. There are different types and different options. And if you ever do work with us, which we absolutely want to work with all of you in the near future and long future as well, it is kind of talking through your goals, your backgrounds, what kind of investors have you been working with and targeting, and what kind of crowdfunding portal or model really fits your investor needs and fits your business needs. As a simple example, you can set up your own crowdfunding portal. Happy to help you do it. There's lots of tech companies that will put up the crowdfunding site for you. You've got to deal with the compliance and everything else with FINRA. There's a larger upfront cost because of getting it all set up, but then you don't have as much long-term costs other than compliance. There are also crowdfunding portals that they'll do the marketing for you. They're going to put your offering on their platform with the other sponsors and deals that they're promoting. And they're out there trying to drive traffic to their own platform. And as long as your deal is sufficiently attractive and you choose a great crowdfunding portal that is getting traffic, you'll get some investors there too without doing any heavy lifting. You got somebody else doing it all for you. And then there's a final option, and you can basically, what do they call it? White page a crowdfunding portal where a registered FINRA crowdfunding portal, they'll be the back end, they'll take care of the compliance, they'll make sure everything works, but they're not going to do any marketing for you. That's another direction to go. So there's quite a few different ways to slice it up, but all of a sudden this regulation CF, regulation crowdfunding, it works and it's useful when it wasn't as useful in the past. It's a great buzzword, but now it is a great opportunity to take your business to the next level. With this, we do file, it's called the Form C with the SEC. It is kind of goes as a replacement to that PPM that you are so very used to seeing over the years. So it's kind of just a different process. We're happy to walk you through it, handle it, help you along. But this is the true crowdfunding as they all know it. Now, what you've seen in the past, just in case you didn't know, when you start saying, oh, well, this platform, they raised $500 million into a fund and they're crowdfunding. Again, crowdfunding as a buzzword, they've all been doing these 506C offerings that allow for the 100% accredited investors with the verification process. So yes, it's crowdfunding, but it's not this regulation CF crowdfunding that allows anybody to invest, just possibly subject to some limitations. Now, there are some financial statement requirements. And I just do want to bring this up because what kind of financial statements you have to get and provide, it comes down to how much money you're raising. And if it's above $1 million, you're generally just required to get audited financials. Those always cost a little more, take a little longer. That does end up being, if for an operating a business, a little hurdle to deal with. It's just something to be aware of. And if it's less than $1 million, but more than, generally, well, $535,000, you still have to get reviewed financials. And just so that to explain, with reviewed financials basically means you gave your financial information to a CPA, they reviewed it, they created your financial statements. Audited means they dove into all of the information and they confirmed themselves the financial contracts, et cetera. So it is a much higher level of requirement for financial statements. And for that reason, CPA firms tend to charge an arm and a leg. All right, now, honestly, I think this is one of the biggest changes that personally very excited about, integration. What integration means is if you're doing more than one offering and you go through a regulatory audit investigation, if the state starts looking at you, they're going to look at whatever your activities are and decide whether it should be treated as multiple individual offerings, or if it should be treated as one continuous scheme of financing, scheme, not a negative thing, but just one plan of financing. And then if they do decide to integrate and treat it all as a single offering, with that in mind, have you violated any of the exemptions for the offerings that you're operating under? Now they have rules now that they did not have before. And really they're paying attention to primarily this 506B offerings or 504 based on state laws. Any securities exemption that does not allow you to advertise versus the ones that you can advertise. But even the ones that you are not permitted to advertise with, they still won't be integrated and combined with the general solicitation offerings, provided that, in fact, the investor was not solicited through a general solicitation and there's a prior relationship before the general solicitation offering ever took place. So all of a sudden you're doing a 506B, and they used to say basically, well, you had to wait 6 months, which was a safe harbor. We'll talk about that before you can do a 506C, or you're risking all this integration. Now, all of a sudden, it's really clear. Did you have an investor that you found not through general solicitation? Or did you actually have a relationship with that investor prior to the general solicitation offering? So we've quite literally completed a number of offerings just within the last month or two that have been under 506B. You can't do the general solicitation. Don't go post it on LinkedIn. Don't start advertising it online. All of a sudden, and we've been coaching people, hey, we know some rules are changing, but we don't know when. And, we truly didn't. When the Biden administration came in, they put a halt on all these new rules coming into play. We weren't sure if they were going to allow the new securities rules to be on the register, be actually enforceable. Thank you, government and SEC. They, in fact, did that. And as of mid-March, these are the new rules. Also, for all those people that we just did 506Bs for, if you hit a stopping point and you're just stuck and your network is used up and there's not much more marketing you can do, there's some solutions for you now. You can do the 506C or the other Reg CF, or if it's time for you to go big, the Reg A, but that's a whole different discussion. Now, all of a sudden, that is a possibility. And if you're doing multiple offerings, such as you start moving forward with a regulation CF offering, as long as you're meeting the requirements of that, and as an example, the 506C, both are general solicitations, they will not integrate them so long as you meet all the requirements across the board. How is this going to be useful for you? I want you to think about it for a minute. And we've got these crowdfunding portals and they're bringing investors to you. And it's wonderful that they're doing it on your behalf, but they're going to charge you for it too. Somewhere between, probably on the low end, 5-ish%, maybe 9-10% is getting up there, but you're paying something for it. And if you're doing a $5 million raise, 5% adds up, 10% adds up even more. However, if side by side, you can be running your own 506C offering and doing your solicitations and driving traffics to your own deal, rather than just only the crowdfunding portal, what a difference that makes. Now, all of a sudden, you're paying 0 fees per investor, other than Reg D fees, blah, blah, blah. But big thing is you can actually save a massive amount of money based on the new integration rules with the opportunity of doing a crowdfunding offering and a 506C crowdfunding offering. And really, you're just paying for the services that the crowdfunding portal is providing versus that be a requirement for everything. Now, this was a huge difference. Previous to last month, the SEC had a rule. As long as there was 6 months in between your offerings, they would never integrate them. They call it a safe harbor because there's other tests that were used and are used for integration. The safe harbor is it doesn't really matter the test. As long as you give it 6 months, it doesn't matter. Now, as long as you have terminated or completed your offering for a minimum of 30 days, 1 month, you can open up a new offering and it will not be integrated. It does get to be a little bit more important. What does an offering ending mean? And obviously, you funded it. It doesn't have to be actually cash in the bank, but what it does mean is there are binding commitments. There's subscription documents and agreements that the investors are obligated to fund. If your entire offering is already committed, then it's closed. 30 days later, you can move on with your next offering. Or, frankly, you just quit funding. It's smart. The rule is you quit funding in all other efforts to fund that particular offering, that deal. The smart thing to do is, in fact, to notify your investors, hey, we have stopped the offering. We are not seeking more capital. This is the end of it. Here's the amount of capital we received. This is the structure. This is what we're working with. 30 days later, you can move on with another offering. It's not going to be integrated and you can just move on. If you are working with a crowdfunding portal, it also works as soon as they just take it off the portal. So that's the end. Something else, and this started to change a little while ago. It started to change last year. Now it is truly just across the board. You are allowed to test the waters for any deals, even if you haven't really figured out the investment yet. You can go through kind of the high level of this is what our plans are. Would you be interested? The big things are it's got to be before the offering, of course. No money is received or accepted. Even if they say, I love it, I want to give you money now, don't. And you also can't enter into any agreements, any binding commitments that, okay, well, how about we go ahead and get this contract all together and you sign this and then we'll worry about doing a offer to you, the official process, whatever it may be down the road. Can't do that. So you are allowed to test the waters. You haven't figured out what offering exemption you're going under. You're still going through the process of developing your plan. You can talk to any of the investors. Just make sure you're not taking the money, making them commit to give you the money, and not accepting any of their commitments to give you the money. Now, even Reg D. There are changes happening, and it's happening to all of the current securities exemptions that you can raise capital underneath it, starting with Reg D, Rule 504. Now, we generally don't deal with this exemption much. A few years ago, it was only up to $1 million. Then it got changed to $5 million, and now it's $10 million. Why do we not deal with it? Because it's still subject to state laws and state regulations. So, and most of states say as long as you're not raising more than $1 million, no problem. They have their own state exemptions to work under. So it does absolutely extend and increase the number of options for you. However, the state laws aren't really keeping up with the SEC changes. So most state laws are still only $1 million cap. There are some that have changed their requirements, and there's still at least one that I'm aware of that they cap it at $500,000. So it extends from hey, we know we have this exemption or this regulation. We know it applies across America. To all of a sudden, I got to pay attention to every single state that I'm raising capital under and make sure that I'm not getting in trouble anywhere. I love that the SEC actually increased that, but does it still really make sense? At some point, I think all the states will start to catch up, and then it'll be a great option, up to $10 million. I keep making it easier, but it's kind of like $1 million Reg CF. Great, whatever. Now, the Reg D 506B, it has always been, you can raise money from an unlimited number of accredited investors. You can raise an unlimited amount of money, but you could only have 35 non-accredited investors per offering. And this is literally the structure that kept getting people caught with integration problems. I know there's plenty of you out there in internet land that have kind of gone through the same thing. Okay, well, I hit my 35 non-accredited investor cap. I need to move on to this next offering. I got this other property that I'm trying to close on, but now I'm running a risk. If there's ever any problems, what's the chance that any of the regulators are going to integrate my offerings? All of a sudden, instead of 35 non-accredited investors, they now add it up to 70, and I've got problems all across the board. I know that that's been a fear for many people that I've worked with in the past. And you know what? The SEC, thank you. They finally simplified this. They kind of did away with the 35 unaccredited investor rule, but not completely. The new rule is you can only have up to 35 unaccredited investors in any 90-day period. To be smart, to be safe, this is a rolling 90 days. If you can chop any 90-day period, make sure you're below that 35 unaccredited investor cap, or you still have some risks. Now, all of a sudden, though, you can do new deals. We get to remove that 35 unaccredited investors. We have to add in the 35 unaccredited investors every 90 days. But all of a sudden, just the sheer number of unaccredited investors and people that you can work with increased exponentially. Congratulations with that. There's great new options, great new strategies that you can implement. It doesn't change the fact that you can't do the general solicitation. Don't put it online. The Facebook, the Instagram is not the right place to be pitching your 506B. There are things that you can do. You can do the 506C, you can do the regulation CF, you can do the regulation A. You can't do the Reg D Rule 506B online. It's just asking for trouble. Don't do it. All right, so we've talked a little bit about this, got into it. And yeah, I'm just gonna skip right over that. You know it. Okay, here's an exemption now to the general solicitation rules. And people have been doing this. The regulators really haven't been enforcing this, but now it actually is the rule. Demo days. You can have angel investor groups. You can have now educational groups, incubators, where people are getting up and pitching their business ideas and their investment plans to the panel of investors. That is now officially allowed, whether it's a 506B with unaccredited investors or not. Hey, they just said that you can do seminars. They are telling you how you need to do your seminar, how you need to advertise it. But this is really the first time that the SEC has said, I know there's no general solicitation, but we're okay with this. What are the requirements? Ads can go out for these presentations, but they need to be advertising the event and not a particular issuer. There actually needs to be multiple issuers that are participating in the event, meaning there are more than one deals that are getting offered by differing people, by differing issuers involved with their capitalization. And finally, there's not commissions, finder fees, anything like that that is getting charged. The promoter of the event can charge more like an administrative fee. Go ahead and pay your costs. You can charge the issuers all day long, but don't charge the attendees. And also, they can't be getting up there in front talking about, we're here to give you investment advice. I've been looking at all these different investments, and these guys today are some of the best. Yeah, that will just get them in trouble. But angel investor groups totally allowed to do this. There are some great seminar groups that have traveled the country and have been doing it for years. I've had some clients that have had great success raising money with these groups. Definitely something to look into. There are specific requirements of what qualifies as an angel investor group. I'm sure there's going to be some questions about this, and we're going to cover it, not today. Also, the only change to the 506C, but I think it's a really important one, is if the investor has been verified already within the past 5 years, there's no reason to think that that's changed. He's still the guy that you knew that is worth $10 million. It's just, it's been more than 6 months. And now you've got to go through a verification again. Hey, can you resend me this info? Can you re-talk to these online verifiers? You don't have to do that anymore. You've been verified. You're verified for the next 5 years with the same issuer group, the same officers that know that you've been verified. And unless you are aware that something's happened in the world that has financially hurt this accredited investor group person, it works. You don't have to keep bugging them again and again and again. We need to re-verify you. So making life easier, one step at a time. All right, Reg A, I'll just talk about it briefly. There's been a very important change to Reg A. Reg A plus the tier 2. Now, instead of only $50 million, they're bumping it up to, you can raise up to $75 million. So all good stuff. It just continues to get more and more useful and allows you to reach higher and higher heights as your business grows and expands. And we'd love to help you reach that next level. Now, one other little change is they've bumped up the limit to the 75 million. And for the sponsors and the prior interest holders, they used to be able to sell your own shares up to $15 million. Now, out of that $75 million limit, you can sell up to $22,500,000 in worth and value of your shares to the public. I'm just giving you a minute to think about that. If you have a good and valid business that's moving forward, it's doing well, and it makes sense to have a $22 million valuation for your interest. You can actually raise $75 million and sell your interest, some portion of your interest, for $22,500,000 into your sponsor pocket. Yeah, you ask me, that is just huge and massive and a great opportunity for those that have gotten past the Reg CF. They've worked the Reg D to death. You've started an amazing business that is taking off, but you really haven't been able to pay yourself. There's a great option now. So Reg A plus, up to 75 million. And if you're going that direction, you can sell up to 22,500,000 of your own shares. Now, the process really hasn't changed. You do have to, hire crowdfunding attorneys. You do have to put together the offering. You've got to go through the audit. We get it submitted over to the SEC. Then there is, of course, the time period, a month or so, that the SEC will review everything. They'll write a letter, generally a really fun and exciting letter telling us all their questions and issues with the offering that's been submitted. They'll send their comments back. We'll go through the process of responding, organizing, and getting everything ready to get back to the SEC. And then the SEC takes about a month. We'll come up with additional questions, additional comments. The fun part is you may end up with a contradictory comment to the last one. These things just happen. Our goal is always to submit once things are great, but the reality is that comments do come back. We do have to go through things with them. And that's part of the reason why with Reg A, maybe we can get it done in 3 months. 6 months is a pretty good target. But even at 6 months, that is assuming that you're staying on top of it, that everybody's doing our part, your part, everybody's part, responding on timely basis. And, 6 months is a pretty good horizon. I got to tell you, a lot of people that we work with don't have their ideas and their plans together, and then don't realize how much information really needs to go into one of these deals. And so oftentimes there's a substantial delay there. And I thank Richard for bringing up kind of our deal. I call it the pre-syndication retention. Oftentimes, we get a call and you've got a great idea. You've got a great plan, but you really haven't flushed out all of the particulars about it. And then rather than just day one saying, okay, let's plunk down a huge amount of capital because we've got to get this thing done and funded and moving forward. That's where we suggest to, especially to new syndicators, new offerings, start the process early. We're offering this, 3 hours to work with you, to bounce ideas back and forth, to come up with the best plan. And then when the time is right, you can just press forward with the syndication. And instead of taking a long time, we get it done relatively quickly. So in any case, back to the topic of the day. We talked about all these different capitalization options. There are changes going on. It is, I love when I did not correct that. It is not 50 million under tier 2 for Reg A. It is 75 million for the tier 2. But, now how much money are you raising? Who are you raising your money from? What strategies do you want to use? And what options are there out there? And so as I've kind of gone through all of this, I hope you're thinking about your own businesses, your own plans, your own opportunities, and what makes sense for you and your business and your investor group. So, we'd love to hear from you. Please, we will be posting this presentation at some point within the next week up on YouTube. I know there's some questions that keep adding up, and we're getting a little bit late in the hour, so I'm not going to answer any of them. However, please send them all our way, post them right now. Next week, we will answer everything and take that wonderful time. And please, if there's anything that I can do for you, email me anytime to schedule a consultation specifically with me. There is the address on the screen, as well as I'm sure Kaylee has posted kind of just our regular website where to link to schedule a consultation. More than anything, thank you so very much for your time. I know you're taking your lunchtime before or after to spend it with us. Thank you.